Hey, today we're going to talk about a hot topic in the Denver housing market, assumable mortgages. If you are a buyer or a seller, thinking about an assumption on buying a house or selling your house, some important tips for you relating to FHA loans and VA loans. Hi, Ray Williams, Mortgage Maestro Group. Let's get into some knowledge about assumable mortgages before you make the decision whether to sell or to buy with that option. First, let's talk about what the hell is an assumable loan? Well, it's very simple. An assumable loan is where you take the existing balance a seller has on their mortgage and you take over the terms of that loan. So if they owed $300,000, they had a 3% loan. Of course, you're looking at the savings you would inherit by doing that. Sounds great, yeah? You cannot do this with a conventional loan. They are not typically assumable. So if you're looking to buy a house and it's really tight between conventional and FHA, it might be something to think about relating to using FHA over conventional if having the ability to let somebody assume your mortgage when you go to sell is important to you. But there's also a few important things to think about. So let's talk about what to watch out for. And along the way, if you have questions about assumptions, drop them in the comments, good, bad, or indifferent, and we'll make sure to get back to you and address them. If you want to chat about this, look, if you do an assumption, I'm not working with you on a loan, so this is all just here to help you guys get educated about the topic, okay? First, veterans. If you are a seller and you are a veteran, there's some important things to know about your VA loan as it relates to someone approaching you to assume that mortgage. The best bet is they're also a veteran and they have eligibility so that they can transfer the usage of your eligibility onto their eligibility, therefore releasing you to go use your VA loan again. A non-veteran can assume a VA loan, but bear in mind if that happens, your VA eligibility, Mr. and Mrs. Veteran, is not reinstated. Therefore, you cannot get a new VA loan so long as they have that VA assumption. So that's very important for you, my friends that have also served in the military. Equity differences. This is the big one. Because if I bought the house for $400,000 and it's worth $650,000 and the loan is $350,000, the buyer needs $300,000. There's some talk about the ability to get second mortgages to make up the difference. I'm the unicorn. Not hearing a lot of successful stories about second mortgages to back up the assumption on the differential. The process requires lender approval. So number 3, what does that mean? As the seller, you have to kind of go through the motions to talk to your lender about them assuming the loan. Getting the approval that your loan can be assumed. It's important. FHA does require that the release of liability is granted. So that's beneficial for those who are a seller and have an FHA loan because you will be released of the liability. In the past, that wasn't the case, and that was dangerous, similar to what I mentioned about for my veterans on their VA loans. But the buyer must qualify, okay? It can be a complex process and a lengthy process. So think about it if you're a seller, and let's say it was gonna take 3 or 4 months. You're gonna hold your house off the open market to let a buyer assume a lower interest rate, whereas you can go to an open market with supply issues. Which buyer would work out better for you? I'm not saying the assumption is a bad choice, but it benefits the buyer more than it does benefit the seller. Let's be honest with it, guys. Be prepared for waiting time if you are a seller. And if you're a buyer, be prepared for waiting time as well. This can be a fantastic deal for both parties if it works out, but look at it holistically, full circle to decide if it's the right path for you. And as I mentioned, pro tip for those FHA loans, secondary financing can be allowed for the assuming buyer. Again, the repayment terms have to be clearly defined in the underwriting analysis for that assumption. Certain mortgages may require a reduction in the principal balance, especially when assumptions are by investors or those doing it for a second home. Now, finding the unicorn of a second mortgage to be able to assume that FHA loan behind the existing balance of the seller on their FHA loan, it might be a challenge for you. But here's the bonus for you. If you're a buyer and you go to do the assumption, you stand to make significant monthly gains. As an example, a $400,000 loan with a 7% rate Monthly principal and interest, about $2,660. If that loan was assumed at 3%, the payment drops to about $1,686 for principal and interest, which is about $1,000 a month difference in cost. So there's definitely the attraction as a buyer to be able to assume this mortgage. What do you think about assumable loans? Drop some comments below. Questions you may have about them, success stories, horror stories, indifferences, and the like. Make sure to check out our next video about the hidden costs of home buying. This is one that even the best loan officers may now and again not remember to review the costs of buying a home as it relates to your loan estimate. We want to make sure you understand all aspects of home ownership and home buying and building wealth through real estate. Make sure to follow us for more videos like this, and we have a catalog, and that's really what this channel is about, a catalog of videos so that you can check them out like an Audible to get educated along the way. If you want a complimentary consultation, calendly.com/mortgage maestro. Thank you so much for watching, and hope this helps you maximize your mortgage savings.